Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracey Ryniec, and this week I'm joined by Zacks Stock Strategist and the editor of the Income Investor, Bryan Hayes, to talk about income investing, specifically how safe are those mega high dividends that are out there? And you know the ones I'm talking about, the ones that are paying over 5%, but some are even over 8 or 9% dividend yields right now. Are you going to get that money or not? Should you be buying stocks that pay these really high dividends that are not REITs or master limited partnerships that are pipelines where you're expecting to get the bigger yields? These ones are just run-of-the-mill corporations that are paying these. And I brought Bryan on this week because he is our expert on dividends here at Zacks, and he runs a whole portfolio with these types of stocks in it. So welcome, Bryan.
Thank you, Tracey. Thank you for having me back on. It's always a pleasure to be with you.
Yeah. So I don't think I'm the only one who's noticing that some of these old school big cap companies that have been around a long time are now paying, some of them, very high dividends. And it does make me a little nervous. And just to let everyone know one of my stories, I think I've shared it on a couple of my podcasts in the past. I was invested in Hanes Brands, which is still around, still out there. And they were paying a very nice dividend and had been paying it for about 10 years. But they ran into a little bit of economic difficulty a couple of years ago during the pandemic, and their earnings started to slide. And that yield just kept going up, 5%, 6%. I think it was over 7% at one point. And I was cautioning people this may not last because eventually earnings went below what they were paying out for the dividend. And you can only do that so long. You have to find the money somewhere to pay out that dividend, but you're not bringing it in. And sure enough, they cut the dividend. In fact, I think they might have eliminated it even. So it was a lesson to be learned on some of these. And I've also talked about Walgreens Boots Alliance on this podcast numerous times because Walgreens was a dividend aristocrat. It was paying that dividend for like 92 years or something. And then they too ran into some, financial issues. The business was struggling. They cut the dividend finally, but then ultimately cut it completely down. And so if you bought that company for the dividend or you were relying on it for the income to live off of or to buy whatever you want to buy with that money, then, that was a little bit shocking. But that's why I wanted to do this podcast, to take a look at some of these stocks that are with these high dividends. But I know that there are two different types of dividend investors. There are the ones that are trying to live off of the income that the company is producing. And then there are those who are longer term investors, perhaps. They're going to reinvest those dividends, buy more shares, hopefully grow their investment in that company. And if you're getting a yield over 7%, that can be pretty juicy to compound that over a number of years if they keep paying that yield. So what do you think is going on out there right now, Bryan, that we're seeing some of these companies that, are paying these really high yields that maybe weren't? Is that a sign of something, or is it just, I don't know. What do you think?
Yeah. So, a couple things here. And I think it's important to harp on the concept of the dividend yield in this case, because successful dividend investors need to understand a few things. And one of them is the dividend yield. And the yield measures how much income the stock will produce. So it's a stock's annual dividend expressed as a percentage of its price. And it's important to understand that a stock and its dividend yield will move in opposite directions. So, and that's as long as the dollar amount of the dividend doesn't change. So, in this case, I think a high dividend yield could be a red flag. The example that you pointed out with Hanes Brands, to a lot of investors out there, a high dividend yield might seem attractive, but you have to be really careful there. If a dividend yield is high, it's usually for a good reason. So, in the case you pointed out, it was due to business weakness, weighing down the company's share price. And in that case, the company's challenges may even cause it to lower, or like you said, in Hanes Brands, stop its dividend payments altogether. And before that happens, investors are likely to sell the stock, which creates additional selling pressure. Looking back in my experience, research studies have shown that historically, after a dividend gets reduced or eliminated, those stocks have underperformed the market by 20 to 25% during the year leading up to the cut. So we know that markets are forward looking. They anticipate these sort of events materializing, and they do a very good job at doing that. So, I always advise investors to be cautious of high dividend yields. I do run the income investor service here at Zacks. We have some names that are diversified across industry groups and sectors that have 5, 6, even 7% yields, but we also take a longer term approach, and we have a number of holdings in the portfolio that have a 1, 2, 3% yield. So in general, I like to focus a bit more on stable companies with strong balance sheets, companies that, and I'll touch on this, I'm sure, as we go on, but companies that have a history of raising their dividends even during uncertain times. So, I came out with a recommendation earlier this year. The company had not only increased its dividend into all of this tariff uncertainty that we're dealing with in the current environment, but they had been increasing their dividend consistently for the past 15 years. It's just a great sign that they're confident in their ability to maintain revenues and grow their earnings, and have that faith that their earnings will be able to sustain the higher dividend payouts.
Yeah, that's key. That's why people love those kind of dividend aristocrats that continue to raise it, not just pay it. Okay, let's talk about a couple of stocks, because really that's what everyone wants to know about. And I picked some of these just out of the blue, but I'd run across some recently in various stock screens. So I knew that they had outsized dividend yields. And I, like I said, I was wondering, can they keep paying that? I don't know. I mean, it seems crazy. So let's start with Whirlpool, ticker WHR. And for those of you listening, I am going to share my screen on YouTube on the video. So I will try to describe, what it is we're seeing. Whirlpool is paying a $7 dividend right now, and it's yielding 9.1%. They did report earnings already, and I'm putting up the price consensus and surprise chart. And when I look at a chart like this isn't good. The shares peaked in 2021, kind of around where the housing market peaked during the pandemic. And then as soon as the Fed started raising those rates and housing really cooled off, and you buy new appliances when you get a new home, or, you're moving, all of that, then the shares have just been on a steady decline since. And I looked it up. So over the last 5 years now, they're down 32%. The S&P 500 is up 92 in the same period. And even year to date, the sell-off has accelerated here, down 34%, and the S&P is down only 4.1. And you can just see these earnings down here on the consensus. And even now, 2025 earnings are expected to be $8.61. And then 2026, if we can see any kind of rebound in housing, at $9.94. But again, the dividend is paying out $7. So I did look to see what are they doing with this. They are very committed to the dividend at Whirlpool, and they are paying it. The next payout is if you're a shareholder as of May 16th, and it's payable on June 15th, this 9.1% yield. But the dividend has not been increased since 2022. They've just been paying $1.75 a quarter since 2022. But that is the high of recent years in the dividend payout. So what do you think on something like Whirlpool? Obviously, if you're looking around for some income, you're not in it. You are going to get some income if you buy in before May 16th. You are going to get some cash, but these shares are at 5-year lows now.
Yeah. So, you kind of touched on it there where they haven't increased the dividend, and that's why we're seeing this high dividend payout as the shares drop. So the market's telling us something. It's telling us that to expect lower earnings or drop in the pace of revenue growth, whatever the case is, in terms of negative revenue growth. I haven't looked at Whirlpool. Was it Whirlpool that the CEO came on and said that he was in favor, or that he thought that tariffs would be good for the business. So I'm not sure. To me, that seems like he's trying to outsmart the market there, and we know how that usually turns out. The market's smarter than all of us, and even though things can reach extremes at certain points, it's not really a good idea usually to try to outsmart the market. So I think in the case like Whirlpool, I think it all comes down to the consumer, and from a broader point of view, are we going to enter a recession? And that's definitely up for debate. We had the 1 quarter of potentially negative GDP here in the first quarter. We'll see if the economy can bounce back in the second quarter here, but the labor market is still holding up very well, and consumer spending is still holding up fairly well. So, in a case like Whirlpool, I think if we do avoid a recession, that will turn out to be a good thing. If we don't, then they'll probably be hit by a weak consumer, and maybe that's what the market's trying to tell us right now, is that to expect weakening consumer spending, and that's why shares are falling. So we'll see how it turns out.
Yeah, this is definitely one I'm just kind of keeping on my watch list. It does have a forward PE right now of 9, but it's got, the decline in those consensus right now, and the analysts are pretty bearish on it. So even that might be more value trappy than anything else. So we'll keep an eye on this one. Like I said, they are committed to the dividend. But another chart to look at real quick, I just wanted to show, was the sales and EPS growth rate. This bar chart, you can just see how terrible it's been since the Fed started raising those rates, both in sales and in earnings. But, the analysts are at least getting a little bit of light at the end of the tunnel for 2026. But they've got to make it through this year, and then we'll see. Eventually, the housing market will turn around in the U.S., and so will their business. But it's been a rough couple of years here for anybody in the housing industry. So, all right, that's Whirlpool, WHR. Another one that I find intriguing for the longer term, especially because I feel like almost all of us have been in this one at some point, is Pfizer. PFE is the ticker. Dividend is $1.72. It's yielding 7.2% now. But over the last 5 years, the shares are down 33.5%, year to date down 11.9%. I'm showing that price consensus and surprise chart, and it's pretty gruesome, almost as bad as Whirlpool here. It too is at 5-year lows, but the estimates or this price and consensus on the consensus side just kind of flat there. 2025 earnings of $3.07. Again, the dividend is $1.72. 2026 analysts are only looking for $3.10, so a change of 3 cents. So not much growth on the earnings side there. And now shares falling. They don't have the weight loss drug, so that has been hurting them. But the shares have been cheap for years. They last cut their dividend in 2009, apparently, when they bought Wyeth. They had to restructure the company, and so they ended up having to cut the dividend there during the Great Recession. But since then, no cuts. So what do you make of a stock like Pfizer, so prominent and so, well known with this kind of yield?
Yeah, so it's funny, Tracy, because over the course of the last few years, once or twice, I've considered adding Pfizer to the
Right.
Income Investor service, and everything's more clear in hindsight. But I'm glad I didn't, because despite periods where the stock's down and the dividend payout's high, and I'm thinking in my head, this could be a good candidate. There's a couple things. The first thing is that the large cap pharmaceutical space is just so competitive, and if you're not keeping up with the big guys, especially in the weight loss drug category, like you mentioned, you're going to get left behind. But it really just goes back to what we talked about, in that it's a trap, in that the share price is falling, the dividend yield is rising. It's trying to pull you into the potential for higher income, but a 6, 7, 8% yield doesn't do very much when the stock's down 30% for the year. So you just have to take that into consideration as an investor. You have to kind of see the whole playing field, and not get drawn into what seems to be a high number on the yield.
Yeah, for sure. Let's take a look at one of the kind of dividend aristocrats, because it's not only been paying the dividend for many years, but it has been raising it. But it is in a very cyclical industry. It's one of the oil stocks, and it is Chevron, ticker CVX. You can also probably take a look at Exxon as well, but I chose Chevron because it's paying a dividend right now of $6.84, and that's yielding about 5.1%. And Chevron's always paid slightly higher dividend than Exxon has. So this is getting us into that juicier dividend category. 5 years, the shares are actually up 43%, but that's underperforming the S&P 500, which is up 92%. Year to date, they're down 7% as the price of oil has fallen under $60. So that's going to pressure the earnings. 2025 earnings are expected to be $7.70. You can kind of see on this price consensus and surprise chart that I'm showing that, the analysts are now cutting for this year and 26 pretty dramatically there. It's expected to be down 23% this year for earnings. And then 2026 showing some earnings growth, even though they're cutting those estimates to 10.54. So 770 is the estimate. Dividend is yielding 684, but it hasn't cut its dividend since 1934 during the Great Depression. And it has raised it for 38 years now, even during the start of the pandemic when oil went negative. Earnings basically collapsed for all the big oil companies. Did come back, into 2021, but you can kind of see some of that weakness back here on the chart. Big misses going on, 70% earnings miss there in the summer of 2020. And then once we got the vaccine, crude started to come back to life. And then we had, gains in the shares. We had the Ukraine war, which pushed up oil prices. And now it's just kind of been hanging out here, but has weakened here. Year to date, down 7%. But these shares are cheap too. They do have a commitment to paying that dividend. A lot of income investors buy both Chevron and Exxon for that reason, because they haven't cut it in decades and decades. And they've even have the commitment to raise it, even if it's just a penny. I've seen some penny raises, but that is commitment to it. But as an investor, what do you think about something like Chevron if you're just looking for it, as an investment more than I'm going to get the income?
Yeah, so we actually owned Chevron for a number of years, and I believe we sold it in 2023, and that was for a few reasons, but as the inflation outlook altered and energy prices began to come down, it was more about reducing our energy exposure as opposed to getting rid of Chevron outright. But more generally speaking, dividends and dividend paying stocks, they exhibit lower volatility than growth stocks and some of the other sub asset classes, and that makes them an attractive vehicle for long-term growth. So I definitely think that investors should have energy exposure, even in this type of environment, where we're seeing high 50 oil prices per barrel. I just think, especially for the case of in commodity related sectors like energy and materials, there's such traditional dividend payers that have this history of paying out and performing fairly well through market cycles. From a longer term perspective, it makes sense. For Chevron, and all of these oil related names, I think they're probably not going to do as well this year. If this dynamic keeps up, we keep seeing falling commodity prices, the inflation outlook continues to subside, but that can change, especially over the summer when people start traveling and the price of oil may tick back up again. So, but from a longer term, I'm a complete advocate of having energy exposure.
Okay. That's good to know. And it's right there at the channel, from the last 3 to 4 years there. So we'll see if it, can break down further, might be a buying opportunity, or if it's going to hold these kind of levels here. Only time will tell. So that's Chevron, ticker CVX. I also took a look at a few other on the chemical side, because they have historically also paid dividends, but it's also been kind of cyclical with some of them. So one I wanted to look at was Chemours, ticker CC. This was a DuPont spinoff over a decade ago now, but it's specialty chemicals, paints and coatings. They have AI type of products. And here's the price consensus and surprise. It is making a round trip. It looks like it's at new 5-year lows here. So over the last 5 years, it's now down 6.7%. Year to date, it's down 28%. And you can see the earnings going, at least the prior couple of years, in the wrong direction. They're going down. But we are, even though 25 and 26 are seeing estimate cuts, they are showing some nice growth there. This is one of the few I was surprised to see what was happening with the earnings side. So 2025 expected to make $1.81, and that's up 49% from $1.21 in 2024. And then 2026 analysts are looking for 254. That's up another 40%. And if I scroll down a bit, you can see the rebound after 2 tough years. 23 and 24 had big earnings declines as shown on that chart. And then we're getting the rebound here. Not a big rebound in the revenue side though, but definitely on the earnings. But what about that dividend? So they're paying $1, and that is a yield of 8.3%. And again, analysts now expect to make $1.81 here in 2025. Now, as we're recording this, they haven't reported earnings yet, but by the time you listen to this, they will be reporting. So we'll see what they say about, the business and what's happening and whether or not this dividend is going to hold. They don't seem to have quite a dedication as some of these others do to the dividend. So that could be up in the air perhaps, but we'll wait and see. What do you think on a company like this that also is a cyclical, but not in the energy side?
Yeah, I think it's something to keep an eye on for sure, especially if their earnings are anticipated to grow, as you mentioned, and they'll be able to sustain those future higher dividends. And that's in the case that they commit to the dividend. And, I think that's something that can draw in a lot of investors. So, in this environment where the S&P 500 dividend yield, I think, is hovering around 1.3%, investors need to be very selective and they need to search for those areas of yields. I think last year, U.S. companies distributed a record 651 or so billion of dividends, but that the dividend yield itself has fallen, and we're hovering near a 20-year low of that 1.3%. So that's a long ways from the more than 4% that we saw towards the end of the 08-09 financial crisis. So this is a company where, you just really need to keep an eye on it. If they're able to grow earnings at the expected pace and they really commit to a dividend, even though that dividend will likely fall if shares begin to rise, it's something to keep an eye on.
Yeah. So we'll be checking in on that earnings report, but that's Humor's ticker CC. C as in Charles, C as in Charles. And then I wanted to wrap it up with another type of old economy company on the chemical side, Dow. Many people used to buy this for the dividend because they have been paying it since 1912. 455th consecutive dividend is going to be paid on June 13th. So you have to be a shareholder as of May 30th to get this one. And they're paying annually $2.80, which is yielding 9.7% right now. And then look at this chart. It looks like the others, though, also 5-year lows. So 5 years, it's down 15.7%. Again, the S&P 500 is up 92% in there. Year to date, it's down 26.9%. So it seems to be, kind of losing it here a little bit. And you can see all the estimates being cut for 2025 and 2026. They've already reported earnings, but they've really been cutting 2025. You can kind of see that light blue line falling off the cliff there. And they're now down to just 36 cents for 2025. Dividend, again, they're paying out $2.80. And that's down 79% from $1.71 last year. Even 2026 looks a little bit better, even though analysts are cutting for that year too, but expected to at least jump up to $1.29. But again, they're paying $2.80. And I did take a little bit closer look at their last earnings report. They return to shareholders in the quarter was $494 million. but cash from continuing operations was just 104 million, and that was down 356 million year over year. They're being hit by slower GDP growth and the volatile market in their industry, which is on the chemical side again. They did cut CapEx by $1 billion for this year to 2.5 billion from 3.5 billion until market conditions improve. So they're in plastics and packaging, industrial intermediates and infrastructure, performance materials, construction chemicals, those kinds of areas. But they did say about the dividend and just the business in general, they're managing a disciplined and balanced capital allocation approach over the cycle. So they're aware in this business, there are cycles. We're in the down cycle right now, obviously, but they too have a commitment to the dividend and have been selling some assets and then cutting the CapEx to make sure their cash flow is appropriate here to pay out these dividends, but you're getting almost a 10% yield with these shares now at 5-year lows. So what do you think about something like Dow when it's paying so far below what the dividend payout is?
Yeah, I've actually featured Dow as my bear of the day a few times over the last, I'd say, couple of years. The chemical sector is one I've mainly stayed away from for the income portfolio. It's just had a rough go the last few years, and I would rather wait until conditions improve and not try to call when we're going to see things bottom out for them, as opposed to trying to catch a falling knife. And even though the dividend payout is extraordinarily high for some of these names, it's just not worth the risk. And you just have to ask yourself as an investor, is this high dividend payout worth the risk of owning the shares? And usually the answer is no. You want to focus more on quality businesses, and not that a lot of these chemical companies aren't. It's just they're operating in an environment right now where the outlook for their growth is marginal at best. So I would just rather wait for things to show more evidence of a turnaround.
Yeah, I'm scrolling down to show the sales and EPS growth rate little bar chart again. And you can see going back to 2022, how difficult it's been on both earnings, but even revenue side of things for Dow. For 2026, the analysts are expecting a rebound, but we don't know. We're still pretty early into 2025. So we'll see if they get that right. But they have been cutting the estimates still, even for 2026, even though it is showing a rebound there. It's trading. Well, here's the forward PE now that the earnings have been cut so drastically. It's trading at 81 times on a forward PE with a PEG ratio of 9.3. So none of those are saying cheap, but this is what happens when the stock, the earnings are just getting slashed so dramatically. So even though the stock is down too, it is definitely a value trap when you see something like that happening.
For sure, agreed. When we look at the dividend space, I just think there's so many better opportunities. So, and with a portfolio, with a certain amount of investment capital, you just have to pick your battles and realize that you can't invest in everything, and you have to really go with the cream of the crop. You should always be focusing on, the investments that you think will outperform in the medium and longer term. But even in the shorter term, you don't want to buy something that may go down 30 or 40% just to have that 8 to 10% dividend yield. So, this isn't a short term game; it's a long term game. But at the same time, you have to realize that a lot of these companies paying a high yield are a trap.
Right. I've always said, you don't get something for nothing. And getting these big, huge dividends like this, when it's not a REIT or an MLP or something where they might pay out more, is always been a red flag to me. So I do go in to do some more investigation to see what's actually going on at the company, what's happening with the business. Is this dividend going to be paid out, or will they cut it if things get too rough? So nothing is guaranteed. People learned that with Walgreens Boots, which finally did cut its dividend even after all of those years of paying it out. So even these old companies that have been paying out for nearly 100 years may at one point still have to say, no, we're cutting it, or we're ending it, or, pausing it. So all those are factors. And yeah, if the stock is plunging, then your yield isn't really going to help you that much, because obviously your initial investment is also going down. So keep those things in mind when you're looking at all these dividends. But I do like to keep a list of these kind of big dividend payers, because as you mentioned, Bryan, the business could turn around later this year or into next year. And while we can't really time the bottom, we might not have to, because the stock might be cheap enough for us to still get in and capture a nice rebound or recovery in some of these stocks. So that's also something I'm going to be watching. And that's why I like to keep the list, just to keep my eye on things. But any other advice for those in the dividends?
Yeah, I would just say, this year where I'm really seeing outperformance is gold miners. They've been doing really well, and certain companies operating in the consumer staples sector. So with this pullback that we've seen in across the broader financial markets, some staples have come into favor, and they're a sector that has historically paid out dividends. And we're seeing some companies raise even in the face of tariffs, so that's always a good sign. And then with metals prices soaring, these mining companies have come on very strongly, and we've been talking about miners in the income investor portfolio for the better part of the last year or two. We own one in the income portfolio, so those are the two areas I think that should continue to hold up fairly well throughout the rest of the year.
Okay. I'm a big fan of those miners myself. So maybe we'll have to do a show and discuss the gold miners as we move on through 2025, because I do think those dividends are going to be pretty juicy with gold at these levels. And now is the time to get some of that cash over there from the miners. Okay. I want to repeat the stocks we talked about on this episode. There was Whirlpool yielding 9.1%. WHR is the ticker. Pfizer yielding 7.2%. Ticker is P as in Paul, F as in Frank, E. Chevron yielding 5.1%. Ticker C as in Charles, V as in Victor, X, CVX. Chemours yielding 8.3%, ticker CC. And then we finish it up with Dow, ticker DOW, yielding 9.7%. But those estimates being cut there. So as always, you want to be sure to subscribe to get the market edge. You can get us on YouTube. Hit the subscribe button there. Just put in Zacks Investment Research in the search bar. You'll find us. Get all of our videos there if you subscribe there, including top stock picks of the week. But if you're just listening, you can also get us on Apple. We're on Spotify, Amazon Music, SoundCloud, just about all the platforms for podcasts, including our own website. You can just click on the podcast button up at the top, get all of our podcasts there. But be sure to get us somewhere, and I'll see you again next week with some more stocks.